All right, for this video, I want to go through the Schedule SE for self-employment tax, and this is going to be for the 2023 tax year. And in this example, we're going to look at a taxpayer that has multiple investments in pass-through partnership entities. And so we're going to be trying to determine how much of that flow-through income is actually subject to the self-employment taxes. So our taxpayer here is John Q. Taxpayer. We've got his full Form 1040 here. So we'll go through the 1040, we'll go through Schedule SE, we'll talk about all of the issues that impact his return. And then we do have the sample K1s from the entities he's a partner in. So we've got one K1 here from Not a Real Company LLC, and then we've got a second K1 from another investment that the taxpayers made as well. And then lastly, I've got one slide here covering some background on Schedule SE and some of these self-employment tax issues that impact partners in a partnership. So the self-employed tax rates, so we're talking about a combined 15.3%, which is two components. So it's Social Security tax and then Medicare tax. So the Social Security tax rate, 12.4%, but that is limited to the first $160,200 of compensation. And then the Medicare tax at 2.9% applies on everything, right? There's no cap. Now, what are the issues with partnerships? So partnerships are certainly a bit tricky. When taxpayers have ordinary income allocations from partnerships, we're talking about their line 1 ordinary income, so if we're looking at their K1, and do they have any line 4 guaranteed payment amounts? So for example, if we look at the first K1 for John, what we're asking ourselves is how much income do you have reported up here in line 1? How much guaranteed payments do you have reported in here on line 4? And then what, if anything, is reported on line 14 as self-employment earnings, right? These are the key boxes that we're looking at. So the question you need to ask yourself before completing SE is, are you a limited partner for purposes of SECA, so the Self-Employed Contributions Act? And the reason why this determination is important, because limited partnership income, so under 1402A13, your self-employed income excludes your distributive share of income or loss of a limited partner, apart from guaranteed payments for services. So when you're an investor in a partnership and you have line 1 ordinary income, ask yourself, am I really a limited partner with respect to this income? And if so, then I can exclude that income from self-employment. Or if I'm actually not a limited partner, right, if I actively participate in this business, should it be subject to self-employment tax? Now, the labeling is really important here, and we'll talk about this recent case here as well. But limited does not mean you are simply labeled as a limited partner. You have to look at whether the person is actively participating in the business, what are they doing? Or are you merely a passive investor, right? So have you really genuinely just contributed capital and that's it? Or are you doing something else that would make that income self-employment income? And the most recent case we have in front of us today is this Sorobin Capital Partners case, where the IRS challenged the exclusion of earnings from SECA for limited partners that were basically actively engaged in the business. So this was a hedge fund, and the hedge fund managers held general partner interests and limited partner interests. And what they tried to do was allocate some of that ordinary income to the limited partners, and they said it was exempt from self-employment because they were state law limited partners, right? And so they're having a lot of trouble winning on that front because the IRS is using this, or the courts rather, are using this, substance over form functional analysis test. They're asking, okay, are you really limited, or are you doing something that generates the revenue in this business, and so it should be subject to SECA? So in this fact pattern, we'll look at John, taxpayer. He's a business owner, and he works full-time for Not a Real Company LLC, a partnership, where he owns 15% of the company. Now, John receives a K-1, which shows line 1 ordinary income allocation of $78,000. And now it's clear that John actively participates in this business. He's a managing member of the LLC. So all of his income is going to be subject to self-employment tax. Now, the second partnership K-1 that John receives is from a restaurant business. So John is a passive investor in a restaurant business. He owns 9%, and he is labeled as a limited partner, a limited LLC member. So John is not a managing member of this entity. He doesn't actively participate in the business at all. He doesn't make any management decisions. And so the position taken by both the partnership and John personally is that the K-1 ordinary income allocation is subject to ordinary income tax, right? So it's subject to that federal income tax, but it's not going to be subject to self-employment. So let's have a look at the return, and we'll try to sift through some of this information. So we've got John taxpayer here. He's a single filing taxpayer. And so he doesn't have any wages here because he's a partner in a partnership. And so you're not an employee. You don't get a W-2. You just get your allocation of income from the partnership, or you can get guaranteed payments. So on Schedule E, what we've done is we've reported both partnership investments. So we have not a real company LLC on row A and the second company on row B. Now, not a real company LLC in this business, John is actively participating in the business. So he has line 1 ordinary income of $78,000, and the entire $78,000 is coded in line 14A, also his self-employed earnings $78,000. In his second investment here, fake investment entity, he has $16,050 of ordinary income, and none of it is being coded as line 14A. Now, what I should highlight here, which is really important, is this determination is made at the partnership level, but you need to be careful that it's correct. So, for example, what I see a lot of times is a partner will be actively participating in this partnership. They'll get a K-1, but the line 14A will be blank. So the partnership return will forget to categorize it as self-employed earnings. If that's the case, and you know, well, this should be self-employment earnings for me, you kind of need to go back to the partnership and ask, well, hey, how come you're not labeling it as such? Now, on your personal return, I think you should do the right thing and report it as the self-employed earnings. But it's important to kind of go back to the partnership and ask, why is this not being labeled as such, right? I know I'm actively engaged in the business. I'm a managing member. How come you have not included all of my ordinary earnings and the guaranteed payments as self-employed earnings? And that's important because when we have a look at the Schedule SE, so let me go to that really quick. The Schedule SE, line 2, the language here, notice it says net profit from Schedule C, line 31, and K1, box 14, code A. So it doesn't say K1, box 1, if you actively participate. It goes straight to box 14, code A. So if you have a partnership K1 and they haven't coded it appropriately, your Schedule SE is going to be wrong unless you know to override it, right? Okay, so let's go back to the return. Talk about Schedule E here. So the Schedule E is where we report the ordinary income. So we've got on the non-passive income and loss section here on the right, we've got our non-passive income from Schedule K1 is $78,000. And then that passive investment in the restaurant business is reported in column H, passive income, because we have a positive amount, right? We have some profits of $16,050. So the total amount of line 1 ordinary income from K1s is $94,050. But when we have a look at our Schedule SE, notice we're only including the amount of line 1 ordinary income and guaranteed payments, if we had any, that are actually subject to the self-employment taxes. So we have omitted the allocation of that line 1 income from our passive investments in that restaurant business. So once you've established, okay, what should actually be included in line 2, then you can complete the rest of the form, right? So in this case, we multiply by 0.9235, so 92.35% of line 3. We're left with $72,033. We don't have any conservation reserve payments. We're not church employees, so that's why 4B, 5A, and B are blank. $160,200 is the Social Security wage limit for 2023. So on line 10, we are multiplying the smaller of line 6 or line 9 by 12.4%, which gives us $8,932. And then we do the same to line 6 by 2.9% to get the Medicare portion of the tax, $2,089, and we're left with $11,021. We are allowed to deduct 1/2 of that self-employment tax on Schedule 1, so we multiply that figure by 50%. So our $11,021 of SE tax goes to Schedule 2. The $5,511 in tax goes to Schedule 1 as the deduction. So if I jump up here to Schedule 2, we can see on line 4, we have our self-employment tax. And then on Schedule 1, page 2, part 2, we have our 1/2 of our SE tax as our deduction, so $5511. So ultimately, and those amounts are reported on page 1 of the 1040 and page 2. So line 1, there's our income from the partnerships. So $94,050 comes through there. And then we have the deduction for the self-employment tax, $5511. And then the actual amount of self-employment tax calculated on Schedule 2 is the $11,021. All right, so that covers it for this Schedule E tutorial. Hope that was helpful. Covered some of the basics on these partnership tax issues. As always, appreciate you watching the videos, and I look forward to seeing you again on the next one. Thank you.